morning, everybody. Chris from Serene Education. Looking at the news this morning, let's have a look and see what's happening here on the charts to start with. It's Tuesday, the 12th of February 2019. Okay, so the majors are looking good. Hence the reason why, well, I'll do my analysis on the majors, but yeah, we're starting to see some cleaner charts on the majors here on the left-hand corner, which is a good sign. Just to bring to your attention that Theresa May will be back in the House of Commons today at some time to try and see if she can bide herself or get some more time in order to work on her backstop issues. Another kicking the can down the street article, but there again, yeah, we've got that to deal with. This afternoon we have the Bank of England governor speaking at 1 o'clock British Standard Time. And then later this evening, well, later this afternoon, 5:45, we have the Fed Chair Powell speaking, but there again, just keep an eye and see how things, maybe not too much to do with the actual what he's talking about, but if he gets a chance to be asked questions, they might want to kind of see what of his thought process is. That also goes for the Bank of England, especially now that we're 40 odd days closer to Brexit D-Day, which is not too far away. The 29th of March is getting closer and closer, and people will be scrutinizing to see what the Bank of England, the governor, has to say. So there again, we might see some volatility prior to the news, prior to him having his conversation, there, or even during and after. So if you're trading any pound crosses, just keep an eye on the volatility, because obviously you and I as traders will be looking to see what his stance is. Okay, so let's look at the euro against US dollar to start with. Naked chart. I'm going to apply the Forex MACD template to this. It's called the FME. It's a level entry template, nothing fancy. Made up of two indicators, which are trend bias. Then we have the relative strength index, which is the RSI, which is an oscillator by choice, but it gives us a positive and negative flow. Above 50 represents positiveness, below 50 represents negativity. So if the relative strength of price on the chart is strong, then we want to see the RSI reflecting that bias. I like using the RSI because I can use it as a Swiss Army knife, purely because if I'm seeing price doing one thing on the chart and the RSI is doing the total opposite, then I know that there's something clearly wrong with the underlying price action, the underlying sentiment within that price action move. Give you an idea, if you look at what happened over the 2015 and 2016 period of year where we had a lot of consolidation, you'll notice that price tested the same level. In actual fact, price, the body lows were trading a lot lower. So if you draw a line at the lows here, you'll see that price was trading lower than the previous attempts. Okay, but you'll notice that the relative strength index was showing less selling sentiment. It was a weaker selling at the hard right edge. So enforcing the idea that the relative strength of the selling that we saw wasn't as strong as it was in the previous attempt, which was this one way back here, which was below 30. So indicating that we shouldn't really be looking to continue to sell this on the hard right edge at this particular point, because there's less genuine selling taking place at this particular point compared to the two previous attempts at the same level over time. Okay, so the relative strength is really good at giving me a convergence or divergence reading, especially on the bigger time frames, which will then allow me to then sit back and say, well, hang on a moment, I'm not seeing a lot of continued underlying sentiment coming in to reflect that move on the chart. Therefore, what I'll do is, there's far too much risk. I will then distance myself from the risk, i.e. stand back, wait for a stronger confirmation, and then I can trade with a higher probability. That's what we're going to do as traders. The indicators kind of help us. They're all lagging to a degree, but they kind of help us in terms of getting a bigger, a stronger confirmation of what it is that price is actually really trying to do on the charts. Okay, so back to the hard right edge. Straight away, that same level that I drew over here represented a strong consolidation, a long, prolonged consolidation over almost the best part of 2 and a bit years. Okay, 2.5 years of support and resistance. And the resistance level clearly there to be seen. So moving higher through 2015, failing to do so. Moving higher through 2016, failing to do so and pulling back. Then 2017 we saw the breakout, the rally towards a moving average, which is the trend bias, up towards the 50, then finding resistance at the 50 before we saw a breakout of the 50, and then a move high towards the 200. That brought us into 2018. We failed to get above that level. Price went sideways for a long period of time, and we saw the break low, which emphasized no more highs, more decisive selling, and we were looking back down towards the 50 period moving average as the viable target level. Why? Because price will then almost this elastic yo-yo effect. If it's trading above one, it'll move to the other. If it's trading below the one, it'll move to the other, etc. So that we've seen exactly that taking place over the latter part of 2018 as we head into 2019 as well. 50-period moving average doing a fantastic job of supporting price as she's fallen. Notice that we saw a breakout over here in October of last year, a breakout and close in towards the lows that we saw in August of the same year. If you draw a line of the August low and you just draw it out towards the future, you'll notice that price has been sitting around this area for the last 6 or 7 months. Okay, we've seen a lot of indecision because price hasn't been able to jump higher or retrace higher. Okay, so it's gone to a consolidation area. Okay, and now you can see that price over the last 1, 2, 3 consecutive months has not made a new high or a new low. So we are sitting in a long-term consolidation, which is which is risky. Okay, because we don't have any continued selling, which is the previous swing in that direction. We're trading below the 200, but we're still effectively trading around that 50-period moving average. The relative strength index is moving with price, because as price is dropping here, you can see that price is driving low, so that's a negative one. The momentum indicator is fast line below the slowdown, histograms below the midpoint, which is telling us that we have selling. But if you look at the histograms, which tells us that there is more selling sentiment coming into the market, because that's what we're looking for, you'll see that the histograms have got weaker. They're still below zero, which is negative, but they haven't gained strength. So over here, for example, you saw continued selling, you saw the histograms getting stronger and stronger and stronger each month. Here, likewise, moving high, you saw the histograms getting stronger and stronger and stronger in that move. We don't have that here on the side. It's just going sideways. It's actually losing strength. But there again, that makes sense because price is not made a new low. She's actually just gone sideways. So what I have over here is a consolidation in what is still a negative intermediate trend. Okay, so therefore, if I'm looking to continue my objective in terms of buying and selling with trend, I know that I have a negative trend in play for the last couple of years. So therefore, I'm looking for that selling continuation, i.e. in this case, if we haven't seen a close over the last 6 or 7 months, I need to see viably a close lower than the current support mechanism to then give me a stronger probability of continuation. I do have a viable long-term take profit level, okay, which will be the 2015-2016 lows, because you clearly see in price over multiple years consolidating at that point. So I have a viable entry if I got it, and I know my viable level I'm going to trade towards. Okay. But there again, I need to see stronger signs of intent. Currently, this month, we're starting to see more negativity. Okay, we saw an indecisive January, where price actually attempted the current low and then pulled back. We traded higher than the November-December high, but we pulled back. So effectively, we still haven't made new highs and lows. So effectively, I have a very strong support mechanism. And if I drop down now to the weekly, you'll see that that box over there represents this consolidation we've seen over the best part of, 13 odd weeks or so. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 weeks. Okay, there's a concern. July. See all the way back in July. So now you can see that we've gone from a very strong bearish outlook at the start of last year. Then we saw some more selling. However, as we head into the 200-period moving average, you'll notice that this is the 50 on the monthly. Now it's the 200 on the daily. On the weekly, apologies. You can see that price has done nothing for the best part of 16 weeks. That is a concern. Okay, we're still below the 50, but we are being supported by the 200. There again, you'll see that the RSI has been below the RSI. We've seen pullbacks to the underside of the 50, but not being able to get above. And even if you did get above, you should still be trading below the 50, which is a concern. So there's higher risk, because remember, your trend is direction by your moving averages. Moving averages are trend bias. So in this case, you can see that we've just seen consolidation in effectively what is still a negative trend. And we're seeing the same thing over here. Now MACD, above, below, above, below, above, below, all over the place. But there again, we've just been going all over the place. We're stuck on a consolidation. Here again, we need to see more of a stronger reflection of a continuation. In this case, we're looking for continued selling because we've come from our high point. Here's the 2018 start. Saw the breakout, and we've just been falling low. Okay, but now we're stuck on a consolidation. Here again, we need to remain patient, okay, and wait for a nice bearish engulfing counter close low to reiterate continuation of the selling sentiment, and then we have that target level, which is the 2016, 2017, the 2015 and 2016 lows, okay, which are these points over here. It's a viable target level. So you can see, if we get a close below the 200, a nice bearish engulfing candle, we'll then be creating a new swing low with direction. We'll be trading below both moving averages, which is a sign that we have a trend in play, a negative trend in this case. The relative strength index would then drop low again, because currently at the moment here you can see that as we've gone sideways, the actual RSI has shown signs of convergence, which is less selling on the hard right edge, which is a concern. If we are to see continued selling, the RSI needs to break the trend line and then drive low to emphasize that we have a true reflection of what price is doing on the chart. MACD in itself would go, the fast line would then trigger below the midpoint, which would be a negative sign, and the histogram would then drop below the midpoint in itself to tell us, yes, we have genuine continued momentum coming back in the market again. These will then all rise the amount of the prospect of probability being far stronger, and then limit the amount of risk exposure that we have, okay, which is important. We do know that between the 200 and those lows we saw in 2015 2016 is in excess of 800 pips. If we get half of that, fantastic time money return for the time we invest in this. Okay, so here again, play caution to the wind, be more cautious in terms of looking for a genuine breakout. You know, we're only in February. If we do get a clearer breakout as we head further into February, that will then give us a stronger return on time invested as we progress further into this year.